The money in your pocket isn't just yours. The invisible network we call the economy has already determined how it will live. Tax. Tax is a mandatory amount that the state collects from individuals and businesses by law. In other words, when you earn income, make a purchase, or own property, you usually pay tax. But the goal is not just to collect money. These taxes are used to finance public services such as healthcare, education, infrastructure, and security. In fact, even if you don't notice it most of the time, with every purchase you're taking on a small partner, the state. The institution that collects tax is the government. But most of the time, you pay taxes without paying attention. Because some taxes are hidden within prices, they are already included in the price of a drink you buy at the market. When you buy gasoline, excise tax is already added to the price you see. On the other hand, income tax is more visible in the deductions on your payslip or in the annual declarations you submit. Taxes are divided into two categories: indirect and direct taxes. Indirect taxes are easier to collect, but impose the same burden on everyone. Direct taxes vary based on income and provide a fairer system. The tax system not only finances a country, but also influences and directs people's behavior. Harmful habits are subject to higher taxes, while beneficial areas like renewable energy receive tax incentives. In short, tax is a shared fund that you contribute to in your daily life without even realizing it. So, where does this collected money go, and how does it grow? Bank. A bank is an institution that securely holds the money of individuals and businesses, lends it out to earn interest, and manages financial transactions. In short, it is the center of where money moves. Money kept at home does not contribute much to the economy, but in a bank, it is constantly in circulation. A bank collects deposits from its customers and, instead of keeping that money idle, lends it to other customers as credit. It earns interest from these loans. At the same time, it pays a small amount of interest to the deposit owner. The difference is the bank's profit. Thus, one person's savings transform into another person's need. Banks are not just places to store money. Cards, transfers, foreign exchange transactions, investment accounts, insurance products, and digital payments are all handled through banks. This allows money to move beyond physical boundaries. In the economy, banks are key intermediaries that maintain the balance between investment and consumption. Interest rates and credit policies are also determined together with central banks. This directly affects the course of the economy. In daily life, a bank is the account where your salary is deposited, the bills paid automatically, and the mobile app on your phone. It doesn't draw much attention, but it is actually everywhere. Money has a cost, both when you use it and when you let it sit. Interest. Interest is the value of money over time. More simply, it is the penalty or reward for using money. When you lend money to someone, you are essentially giving them the opportunity to use that money for a certain period. The extra amount you receive in return is interest. For example, if you give 1,000 and receive 1,100 after a year, the extra 100 is your interest income. Interest exists not only between individuals, but throughout the entire financial system. Banks earn interest from loans and pay a portion of it to depositors. Even governments issue bonds based on interest rates when they borrow. The basic logic is this: the value of money today is not the same as its value in the future. Interest is calculated in two ways: simple interest and compound interest. Simple interest is applied only to the principal. Compound interest grows by adding earnings to the principal, allowing money to multiply over time. Interest rates determine the rhythm of the economy. When they are high, spending decreases. When they are low, the economy becomes more active. In everyday life, it appears constantly, even if you don't pay attention to it. Imagine a world where your money loses value even if you do nothing. Inflation. Inflation is the rise of prices over time. In other words, if you can buy less with the same amount of money, there is inflation. For example, if something you bought last year for $20 costs $30 this year, the difference is inflation. And if this increase occurs broadly across many sectors, it means the economy is deteriorating. Inflation is normal up to a certain level, but when uncontrolled, it reduces living standards. The main causes of inflation are increased demand, rising costs, and expansion of the money supply. Its effects are felt across every sector. Wages become insufficient, savings lose value, and plans are disrupted. That's why central banks try to control inflation through interest rates. Low and stable inflation is harmless, even ideal, but high inflation is enough to destabilize the system. That's why inflation is sometimes called a hidden tax. The economy doesn't always grow. Sometimes it slows down, even shrinks. Recession. A recession is the slowdown or contraction of an economy. It's not just growth stopping, but gradually reversing. Generally, if an economy shrinks for 2 consecutive quarters, it is considered a recession. During this period, people spend less, companies cannot sell, production decreases, and unemployment rises. This situation continues in a chain reaction. Spending drops, production falls, and the economy declines further. Recessions usually emerge after high inflation, high interest rates, or crises. During such periods, governments try to stimulate the economy by lowering interest rates, increasing spending, and applying measures like tax cuts. The goal is to inject money back into the market and restore confidence. A recession is a difficult period, but sometimes it is necessary for the system to reset. Banks don't know you, but they never forget your behavior. Credit score. A credit score is a numerical value that represents a person's financial reliability. Banks use this score to decide whether to lend you money. In the United States, this score ranges from 300 to 850. The higher it is, the better your chances. This score is calculated based on factors such as payment history, debt amount, and credit history. Paying your credit card debt on time increases your score. Delaying it lowers your score. It affects not only your ability to get a loan, but also interest rates and credit limits. In short, this score is your reputation in the financial world. Value. Value describes how important or useful something is. In economics, it explains how much a product is worth to people. Price is the numerical form of value, but they are not always the same. A product may have a price of 100, but its value to you could be 50 or 200. In economics, there is use value and exchange value. Water is very useful but cheap. Diamonds are less useful but expensive. This is called the water-diamond paradox. Value is not purely mathematical. Trust, brand, and emotions also play a role. That's why the price is written on the receipt, but people determine its value themselves. Earning money is one thing. Growing it is a completely different game. Investment. Investment is the act of using money today to earn more in the future. In other words, it is money quietly working on your behalf. Saving accumulates, investing grows. Putting money in interest, buying stocks, accumulating gold, or starting a business, all are forms of investment. But every investment involves 2 things: risk and return. Low risk means low return. High risk means higher potential. The most striking aspect of investing is time. In the short term, there are fluctuations, but in the long term, balance forms. That's why patience is very important. In essence, investing means giving up a bit of today's comfort to gain future security. Currency. A currency is the official medium of payment of a country. In the United States, it's the dollar. In Germany, the euro. Money serves 3 purposes: to make transactions, to measure value, and to store value. But its value is not stable. Exchange rates are constantly in circulation. This circulation is related to supply and demand, interest rates, and economic confidence. Central banks aim to maintain this balance. Money is no longer just paper. Digital payments and cryptocurrencies have become an important part of life. In fact, behind everything there is one invisible force: time. Time. Time is the quietest yet most powerful element in the economy. 100 today is not the same as 100 tomorrow. This is called the time value of money, because today you can spend or invest that money. Interest actually stems from this idea. In investing, time is the greatest advantage. Over the long term, compound returns grow. In short, time is like a ghost currency in the economy. It is spent, but it cannot be brought back. Because in the end, the winners are not those who earn the most, but those who understand the system.